UPS has just reported its earnings. It is down around 4.5% currently. It has gone down to 6% and may go down even further when the market opens. Is it an undervalued now must buy? We're going to take a look at this company, the historical performance. We'll touch upon their income statement, their top line revenue, as well as their bottom line given their earnings report. We'll also look at the balance sheet, have a quick health check, total cash versus total debt, and we'll see how well not only UPS have performed over the last 5 years, but the industry and some of their peers. We'll then get into their dividend safety, look at some of their financial metrics to see whether or not they are supported for the longer term. We'll discuss some insider selling that has taken place over the last few months, and we will see what the institutions are doing quarter on quarter. We'll then take a look at the earnings and see exactly why this stock has come down and what exactly is going on for the future guidance. And as always, we will run them through the valuation model, getting to the intrinsic value and acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they forecast as a price target over the next 12 months. So let's get into the earnings report and see exactly what is going on. Now, the headline states that UPS slumps as muted 2024 sales outlook offsets the mixed Q4 earnings. UPS called 2023 a unique and difficult year and doesn't have a great outlook for 2024. So let's just take a look, digest some of these numbers. Now we can see that UPS posted modestly better than expected Q4 results. So let's take a look at their numbers. Adjusted earnings, $2.47. Now these were down 32% when we do the comparative for the previous year, but in actual fact they did beat Wall Street estimates by 1 cent, $2.46 versus estimates of $2.46. However, their group revenue unfortunately fell quite a substantial 8% to $24.9 billion, shy of analyst estimates by quite some bit at $25.45. Now, taking a look at some of those numbers in details, we see their domestic segment revenue falling 7.3%, as well as international revenue down 7%. And for the upcoming year, we can see UPS see their revenue in the region of 91 to 92 billion, a 3.9 increase from the previous year. Now, remember what we always say on the channel, we want a minimum of 3 to 7% growth year on year. We're about to take a look now. So this is on the much lower end of that scale. So let's take a look. Now UPS is down, as we can see, 11% over the last year. It will go down further now based on when the market opens. It is now on that $150 price, heading towards the lower end of the 52-week range. The yield will now be heading towards a 5% yield, and we can see that forward PE will be sitting lower than the 18. Over the last 10 years though, if you have been holding UPS, you would be up 66%. Bear in mind, it doesn't include those dividends reinvested, and we can see their all-time highs sitting around $225, so they have come down quite some way. So let's take a look at their top line now. Remember, we just mentioned 3 to 7% growth year on year. So they reported $72 billion in 2018, $100 billion in 2022. So the positives, we can look at that first. They have grown their revenues over the last 5 years. And in fact, year on year, they have increased that top line, which is nice to see. Based on that earnings report that we just heard, their essential December 2023 is around that $90 billion. So they have in actual fact had a drop to that top line of nearly 10%. So it's just something to consider there. Yes, their top line has been increasing, but the last year, 22 to 23, has been a near 10% drop. In terms of their bottom line, $4.8 billion reported in 2018, $11.5 billion in 22. So nice growth on the bottom line, but again, we need to look at the granular level to understand. 2018, it actually dropped all the way to 2020 before picking back up, dropping again in 2022, and again that December 23 net income is lower. So mixed results in terms of the analysis on the income statement. There is growth, but again 2023's results has shown a drop both on the top line as well as the bottom line net income. Quick health check, well, $5 billion cash in 2018, 7.3 from the latest report. So they are holding more cash and short-term investments than they did 5 years ago. In terms of comparing that to their total debt, what we can see, it has gone up from $23 billion to 25 billion. So very minimal growth in the total debt, but so has the cash. So both have gone up, and we'll take a look at that dividend safety based on the net debt to EBITDA metric. Very quickly then, other companies in the air freight and logistics, we have well-known FedEx and we have Deutsche Post as well as a few others. Now, over the last year, we do see FedEx down. Remember, this includes those dividends reinvested. This is total return, down 7%. Now, it will go down further once the market opens. So we can see it hasn't had the greatest performance. Now, when we extend that to the last 5 years, what we do see is that in actual fact, it is up 83%. In the mid performers of the industry, although again it will be slightly lower than that when market opens in a few hours. So again, just something to consider. It is past performance, so it isn't necessarily an indicator of future, but we can see that it has at least had a positive total return. Very quickly then, for insider trading, as always, we take a very quick look over the last 6 months. We can see we've had to go back that far to see any movement, and we see their president, Nando, who did sell around 22,500 shares at a price of $171, so a little bit higher than the current trading price, so $4 million worth. Now, as always, insider selling isn't necessarily a bearish signal. It is just something to consider. Insiders sell for many reasons, whether that's personal, whether they need the money, the financial reasons, but it is always good just to take a look as part of that investment thesis. Now, institutional ownership, it does sit at 58%. We did see around 8 billion worth of sales by these institutions over the last 12 months. In the same period, more than double, 15 billion. And when we take a look at 2023, more buying than selling in Q1, Q2, more selling in Q3, but we can see a lot more buying in Q4. So whilst institutions do quite like UPS, they have been buying, we can see it isn't something we should always just take, and we should always do our own due diligence regardless. Now, dividend safety score 69, market cap 135 billion. It is a mega cap company. In terms of the recessionary metrics, while they maintained the dividend in the last recession, they didn't increase it, they also didn't cut it. They had average growth of negative 12%, and they also beat the S&P negative 48% versus the S&P's negative 55%. In terms of dividend growth, well, 6.6% in January 23, so we will be shortly expecting an increase to that dividend announcement. 13% over the last 5 years, 20 years, 11% year on year. So nice to see. It is still at least increasing it above that 4% inflation rate. And it's important to remember you want to be getting at least 4% in your dividends, salary, other income producing assets to essentially not lose your purchasing power or take a pay cut, as the US inflation rate over the last 40 years was 4%. They have also been increasing those dividends for the last 13 years. Now, dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. Not only do we have a sign of undervaluation, but when the market opens, this will be updated to go higher in the 4.5 region. So again, a very strong sign of undervaluation. And again, this forward P will drop probably roughly in line with the 5-year average. So we do have that sign of undervaluation. But as always, bear in mind, we're not looking at any of these in isolation, and we will conclude towards the end. Industrial sector P also sits higher at 19.7. Now, as always, earnings data is susceptible to manipulation by management through accounting. Free cash flow payout, let's focus on that. 60% or lower, my personal preference. Gives me faith management are able to effectively allocate their capital. 2023, 99%. What this is signaling is that management are expected in 23 from that annual report to pay out nearly almost everything they generate in free cash flow as a dividend. A bit of a red flag indicator, and when you look at the earnings, you would not have realized that by looking at that 64%. The only positive to note is in 2022 it was 57%, 2024 expected to come lower, but still a little bit higher for my liking. Now, in terms of the free cash flow per share, what we can see, it has nearly doubled over the last 10 years, 557 to 1070, but we can see here it did have a negative free cash flow in 2017. It is also very inconsistent, and we can see that clearly 2023 expected to be lower than the 2022. Now, in terms of sales growth, 3 to 7%. We did mention this drop in that 2023. It is looking like 8%. But overall, other than that year, they have had fairly decent growth, 3 to 7% nearly every year, and some strong growth in 2020 and 2021. When we look at it numerically then, they've pretty much nearly doubled their top line over the last 10 years from 55 to 100 billion. They also do this, although not very consistently, share buybacks, returning excess cash to investors. Although we do note from 2013 we see this to 2019 before the share count going up. So they've done both. They have issued equity to dilute your position, but the net position is a share reduction. ROIC, remember 10% or more, otherwise it means management aren't able to effectively allocate their capital. So it is nice to note the mid-20s for UPS over the more recent period. 2023 expected 20%. Margins, well, if we look at the free, or if in fact the operating margin, they have straddled around that 12% year on year, so no surprise 2023 at 11%, but just something to keep an eye on. You don't want it to go too low because then their bottom line will be squeezed even further. Free cash flow margin, pretty much similar story. It does tend to straddle around that 5% year on year. Net debt to earnings before interest, tax, depreciation, amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. It affects the dividend safety and shows us the balance sheet strength. 2023 at 1.16 isn't too bad. It's significantly lower than 3, so the dividend does look to be safe and the balance sheet does look to be in good order. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model. Now, we have Graham's valuation formula, the earnings per share, growth rate per analyst estimates, and that AAA corporate bond yield, giving an intrinsic value which is slightly lower than the market value. So we have a first sign of overvaluation. Do keep in mind that we don't look at any of these models in isolation. We will draw conclusions towards the end. We then have the multiples valuation model, the companies in a similar sector and size, average P multiplied by that of UPS to get an intrinsic value with our first undervaluation signal. We then move on to the dividend discount model with the yearly dividends, as we can see here. Average growth rate 13.5%. Forward looking, I have gone for 4.25%, so it will be interesting to see that dividend increase. But as always, that is purely just based on my own estimations. We have an intrinsic value then, again showing another sign of undervaluation. We then move on to the discounted cash flow model with the free cash flows year on year. Average growth rate negative 37%. We have gone slightly lower than analyst estimates, forward looking to be more conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide by the shares outstanding, we can see here our third sign of undervaluation. Now the intrinsic value is just the average of these four models, and in today's episode for UPS it's coming to $169. Don't forget you can grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list by clicking on the pinned comment below. So margin of safety, we use 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see it is around that 10%. If we go 15%, you would have to wait to around $144. So right now we see at least a 10% margin of safety. In terms of Wall Street and what they forecast, based on the report and based on forward looking over the next 12-month period, they see around 20% upside at a price target of $180. As always though, do let me know your thoughts in the comments below. Is this one that you do see going even further later today or even tomorrow? Or is this a very solid price with a yield heading towards that 5%? As always, if you enjoy the content, smash that like button, hit that subscribe and bell button. See you on the next one, and for now, take care.